the styles and skills of top traders to join me live every weekday right here on ausbiz.
The Trade is brought to you by Markets.com. The world of financial markets, your way. Make the switch today. Did you know that over 80% of trades can occur outside of normal trading hours? Opportunity doesn't wait. Trade more than 70 key US shares 16 hours a day this earnings season.
Love it or loathe it, as an investor, you simply can't ignore it. Digital currencies, blockchain, smart contracts, NFTs, Web3 and more. We want to understand and explain the entire ecosystem, which is evolving by the day. We'll talk to the developers and investors in the ecosystem to find out where the opportunities are. Join me for Cracking Crypto, weekdays only on ausbiz.
Cracking Crypto is partnered with City Index. Trade shares, CFDs, Forex, crypto and more with a trusted provider.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good afternoon to you. A warm welcome from us here at ausbiz. This is The Call, 10 stocks picked by you, 2 expert guests, all in the course of an hour. Friday, 11th of February, I'm Nadine Blayney. I haven't been sitting in this seat for quite some time, so it's a pleasure to be bringing this program to you, and a pleasure to have the chance to speak with our 2 expert guests who are here for the whole hour. Junbei Liu from Tribeca Investment Partners and Mark Gardner from Maqro Capital. Mark, welcome. Nice to see you in the studio.
Hi, how you going?
You dodged the rain in Sydney?
Yeah, I think it's been pouring about the last 3 times I've walked down here, so it's a bit of a dodge underneath the awnings.
Yeah,
but,
well, we appreciate you coming in. And Junbei, everything's going well with you. I know this is a very busy time of year for everyone working in markets, with reporting season really getting underway this week.
Oh, absolutely. Look, things are going very well. But what's interesting is that though the results are coming out as expected, or if not better, it's just the market is going through its own tantrum at the moment, with the macro overlay of the interest rate potential going higher, and the market's going through its readjustment of the expectation.
Look, the macro always creeps into the conversation, but we are going to keep it pretty stock specific. So with that in mind, let's go through some of the stocks that we'll be talking about over the next hour. CBA, GNG Engineering, 7 West Media, Mirvac Group, and Sonic Healthcare. So those are the 5 stocks that we'll be discussing in the first half of the program. Let's get to the stock of the day. And I thought we'd take a look today at baby Bunting. So it failed to provide full year earnings guidance, again, blaming the uncertainty caused by COVID on the retail space. Profits increasing some 16%. All stores remaining open, which is surprising, paying out a 6.6% per share dividend. Online sales did the heavy lifting, up nearly a third during the 6 months to December. Shares, though, coming under pressure in morning trade. So let's get the view on baby Bunting with Junbei Liu from Tribeca to start. Junbei, look, positives are sales momentum, margins increased. Also, those online sales hitting 24% of sales. What were the negatives? I mean, why is the market not liking this one, do you think? And do you?
Yeah, look, the main reason in market is a bit negative is that they didn't really provide a guidance. So that is creating a bit of issue. And also at the same time, they're building a lot of inventory. The inventory is growing really, really fast, post the Christmas promotional period. So I think the days of inventory has climbed to 116 days. So that's what it is. But overall, the result was pretty solid, was pretty good. There was good growth, talking to good growth. But obviously, with the outlook, the company is sort of saying uncertain. And the reason it's uncertain for this company is because it's been a huge beneficiary of COVID, it's the sales, what it might look like going forward in the next 6 to 12 months might be a little bit uncertain.
Also,
but my view is that this company.
Go ahead. Sorry, Junbei.
Oh, I was just thinking this company is actually a fantastic business. Whenever it gets sold off, really should take that advantage. Take the sell-off advantage to buy this business. But store rollout is still a lot to go, and 50% of its store still less than 5 years old, which means its margin will continue to expand. And once we're through this cycle, this company will make significantly more money than what it was. So it's a great company. You should be really buying on the week.
Well, that's a buy coming from Junbei. Do you see it any different, Mark? I mean, it is in retail. It's in specialized retail. We're going to keep having babies.
Well, yeah, particularly if there's lockdowns, I suppose. So, look, I've got 4 daughters, so I'm pretty familiar with this store. I think I've probably bought about 6 prams over the years, so they tend to, there's always something new or more convenient. Look, not providing the guidance obviously hits them a little bit. I don't, NASDAQ negativity and the bond yields being higher probably didn't help realistically overall. But in looking through the numbers, it seemed to me like they were fairly solid numbers. One thing that no one else has said is that they've got no supply chain issues, whereas everyone else has sort of flagged that. So their costs were up a little bit. I think they missed a little bit on expectations on EBITDA. Look, and they are a slightly higher PE, but as Junbei said, like they've got some stores in early stage, so that's perhaps justified. Look, they pay a dividend. Perhaps we probably wait till the smoke clears a little bit with these, with these benchmark yields going through, pretty significant highs at the moment. I think there could be some overall weakness. I probably wouldn't be buying necessarily today, although I don't know why on the back of those results the stock's really down, to be honest. They look fairly positive to me, but I think you may get them slightly cheaper just on the broader market pulling back a little bit, but I agree with Jumbo. I'd be buying the dips on this one. So.
But not today, so it's not going in the portfolio. Them's the rules, folks. And we will update you as to how we will run the portfolio from here on in a little bit later in the program. But interesting one to keep in mind. Baby Bunting, stock of the day. Let's go to what perhaps is the stock of the week. And this one is coming to us from Bridget. CBA. CBA, buy, hold, or sell, Junbei?
Look, I would say, this is very much a micro call. So I would say CBA is a buy because the operating environment does look like it will get better with the potential expected higher interest rate potentially take place, later part of this year. Now, the banks are very, very leveraged in terms of earnings margin to the higher interest rate. So once Reserve Bank increases rate, the bank will push it through in their mortgage market, and then the margin will start to expand in 6 months' time. So it's very leveraged. Look, amongst all the banks, this is the most expensive, but it is the best operating bank. Aside from NAB, it also has reported very strong result. So out of the bank pick, I would say, this one is very solid, pays a good dividend yield, have announced $2 billion buyback. It looks reasonably positioned, at least for the next 6 months, as the interest rates start going higher.
Yeah, this is very much, Mark, a macro call. Banks make more money when they can charge more money of their customers. I mean, that's a pretty simple equation. And Matt Coleman, we interviewed him this week, Kashi did, and he really laid it out in that interview exactly how it impacts earnings. And so you can go back and take a listen to the interview, but there should be pretty good times ahead as long as the economy continues to go strong and as long as they haven't been lending to people who won't be able to service those loans.
Yeah, look, I don't think that's going to necessarily be an issue with unemployment at 4.2% or 4% or whatever it is at the moment. Realistically, people are going to be able to repay those loans. I think that's probably the key thing to watch out for in terms of defaults is if the unemployment rate starts to go up. At the moment, it's the opposite problem. We've got labour shortages, etc. So, and wage cost pressures to the upside. Look, I'm not a massive fan of the Big Four generally. Obviously, we've always got clients with their on, so I get asked these questions a lot. CBA is a staple for anyone who wants to hold the Big Four overall. So I'm just going to call it a hold. I much prefer Macquarie Bank. The Banks ETF for the US banks has been going quite well as well. They're going to get that rate hike a bit sooner and probably a little bit more aggressively. And it's sitting at record 52-week highs at the moment. So they're with Macquarie Bank around here at 190, and that ETF performing quite well. That's my preference in the financial sector. But look, for conservative investors who want the dividend yield and the franking credits, then I think it's definitely a hold. It's performing quite well, but if you're looking for growth out of a stock, I would generally just not really considering the Big Four. They've got a lot of those fintechs eating away at their high margin businesses, and look, the interest rate environment will help them. Don't get me wrong, but at 99, look, there's a lot of decent dividend stocks out there at the moment that have potentially got capital growth as well, share price growth. So it's not really one for me generally. And obviously with Macquarie at 190, saying they've got record profits upcoming and not being very specific, and with the history of promising over delivering, I'd much rather be in that. So, and the dividend yield's fairly similar. So, but yeah, it's a hold from me.
Bonus buy for Macquarie, though. We'll end that one there. Get to GNG Engineering Services for Murray. Hi, Murray. I hope you're watching. GNG is the ticker code. Now, Murray provided a lot of background on the company. So it is, engineering services in a nutshell. So it does a lot for the mining and mineral processing industry. It's, as Murray points out, paying a 9% plus grossed up dividend. Maybe I'll start with you on this one. Mark, what do you think of GNG Engineering Services?
Look, it's not a sector we generally focus on, particularly of late with the high labour costs, etc. So in West Australia being shut, crippling the industry a bit. I think they're fairly geographically diverse. Worley's is one that we're long in this sector from sort of towards the bottom of the range there. Quite like I quite like their shift into green into the green services, so which will be a growing business. However, their PE is infinitely higher than these guys. So look, the chart's super solid. We're hopefully coming out of lockdowns, etc. So those labour costs may drift back. Look, I'd probably say it's a hold at this stage. I don't think I can buy it up here with sort of these lofty heights, but it's been a solid performer. Its PE ratio is around about the sector average. So yeah, look, if anything, I'd be more inclined to slightly trim just in case we get any further shocks in terms of COVID, but because it has had a really great run. But if you're hunting for yield, then it's not a bad one. Yeah, but at the moment, I'm probably not Worley at these prices, but on a dip, I'd probably be preferring something like Worley's. I mean, they're not necessarily like for like, but
to gain exposure to that general thematic, that's how you would do it.
Absolutely. Yeah.
Okay, let's go to Junbei Liu on GNG Engineering Services, because this is, again, I mean, it's a reflection of what's going on in the macro environment. There's a lot of exploring, there's a lot of digging going on right now. So this company is poised to gain in such fertile times, but the cycle will turn, right?
Yeah, look, it's true. The cycle will turn. And to be honest, I had a look at their recent results. It actually looks, this company hasn't really been impacted by all that severe labor shortage that other mining services companies are experiencing. So it's actually done incredibly well. Look, the company, it doesn't look expensive, trading on just under 10 times next year's earning, or this year's earning. And I think it's performing really, really well. If anything, I think this company is probably a good pick out of the crop. So far this year, so far this week, actually, we heard from Downer talk about wouldn't give guidance. We talk about labor shortages, high costs, disruptions. We got CIMIC also had a very poor result. So looking at this one, actually, it looks pretty strong. So I would say that I would put a buy on this one. Given its performance so far, execution has been really good, and it's got a very good pipeline as well, and continued contract win. And it's not expensive, and it sits in that value bucket. It gives a good dividend yield. I think it's a buy.
Okay, I love when we get a bit of disagreement as well. Choose your own adventure if you're Murray. Thank you so much for the question. Let's get to the next on our list, which is Seven West Media, for David, saying, I know you've covered Seven West fairly recently, but given that reporting is coming next week, the company reports, and David, and I think that this is so good when our viewers give us context, he's considering selling them. And he bought them, Junbei, at just over 7 cents. So asking for a little bit of guidance. I mean, do you wait for the report? Do you look to sell? Would you be selling into strength?
First of all, the viewer has done incredibly well. If you bought it just after 7 cents, the share price is just around about 70 cents. So look, I think in terms of cycle, you still got a little bit more. Recent SMI data has shown TV market has grown incredibly. It's still doing double digits. Now, in terms of the rating, I think Channel 9 started stronger because of the tennis and things, whereas Channel 7 hasn't started as strong, but still it's holding its ground. So I think earning is going to be in a big upgrade over at least the next 6 to 12 months. The result is coming through. I think it'll be very, very strong. And don't forget, this is also an election year. And remember, every election year, TV market benefit enormously because of the election campaign that has run. So, TV, expect to have very strong TV market, and this one is the only pure play. Now, understandably, this is it's a traditional media, so it doesn't have long run rate because it's in structural decline. But you're paying very little. You're paying something like 4 times its earnings, just assuming in 4 years, suddenly all the TV revenue shut off, this is how much you pay for it. So it's very cheap, it's an earnings upgrade, and I would wait for the results. It depends on market volatility that you can potentially profit. But look, it's something that still have very strong earnings growth right for months.
Yeah, so be patient. Don't hit the sell button too soon is what Junbei is saying. Yeah, this is for David. Mark, I think he raises a good point, though, is that sometimes it's just as important to know when to sell. If you've had a good run with something, you don't hold all companies forever. So given what Junbei has said in terms of strategically waiting for this report, the cycle has a little bit juice left in it. Would you agree?
Oh, absolutely, yeah. I think that election year piece that Junbei mentioned before is key, and there's going to be a bit of a battle over the election as well. So I think spending's going to be through the roof overall. That PE is super low. Look, it was just great buying from the viewer, essentially. I think at this stage, it probably just affords you a bit more leeway to hang on overall. Look, and seasonality-wise, both 7 Wests and 9, February's February, March are their better months, basically. Looking at the seasonality in share price performance, basically around when they report, they're by far the 2 strongest months for both the companies. So I'd be with media spend going up as well. I'm very happy to hold on to this. I'd be fairly inclined to buy this. We've bought 9 the last 2 reporting earnings seasons in the weeks leading up to it, and done relatively well out of it. So look, I mean 9's got a yield, I suppose, but it's but this one, we're with that media spend coming up for the election, there's
no need to go anywhere.
They can flag a really positive outlook, which the market's received extraordinarily well generally. So I think it's fairly cheap. I'm happy to call it a buy at the moment. Yeah.
Okay, so that's actually a buy from Mark Gardner from Maqro Capital. David, congrats. Everybody's agreeing that you've done really well on this company. And I've got to say, the voice generations, I mean, my household was hooked. I don't know about you and your 4 girls. I think 9 might actually do quite well out of this upcoming interview with the Prime Minister's wife. I don't know if anyone's seen some of the ukulele playing that's been put out there today. It's oh dear is right. Okay, let's get back to our business of stocks, and this is for Harry. Mirvac. Junbei, I'll start with you. So Mirvac reported this week. In the wake of that, it's got its target price cut by Morgan Stanley. But we've got also a report here from Citi saying that Mirvac's first half miss presents a pretty attractive opportunity for investors to get into the company. Junbei, what do you think?
Look, I think Mirvac is a high quality business. Look, yesterday's share price went down. It's partly because people were expecting a big upgrade, and it obviously didn't come through yet. So operated by very conservative management, so it's nothing to be worried. Result was good. In the result, actually, what's really strong was the residential sort of side of the business. So remember, Mirvac, they have big exposure to not single home, but multi, like the apartments and the big buildings. So that took a long time. The multi-home buildings took a long time to turn, and then we see it's turning. So that contribution is actually becoming quite strong. And that was a very good result. Now going forward, I would say Mirvac's more of a hold because first of all, housing market is going through next 12 months. You can say that housing market will be a little bit more challenging. Not a collapse, but will be a little bit more challenging because of high interest rate. And at the same time, it does have has very high quality retail and office assets. So with high bond yield, it tend to get valued a little bit lower. So on that basis, it's more of a neutral. It's a hold. It's a small dividend yield, but very high quality assets. So for investors want tiny yield, but high quality asset and willing to ride through the cycle, then you can have it in your portfolio.
Got it. It's a hold from Junbei for Mirvac. Harry, Mark, what do you the number crunchers at Maqro sort of think about Mirvac?
Yeah, look, it's got a macro score of about 5.8, which is reasonable out of 10. We much prefer the industrial REITs. CIP is one of our favourites, or we got AFR article just recently saying industrial rents could be up by 50% over the next 4 to 5 years. So we probably prefer that space. I don't think there's anything wrong with the company. I tend to agree with Junbei. higher interest rates, residential properties, very toppy at the moment. I mean, mind you, everyone says that every 3 years and they're still going up, but many analysts have been, put into the fire on that one. But
it's like weather forecasting the weather when it comes to housing prices.
Yeah, pretty much. So, but yeah, look, I couldn't go more than a hold overall. We're not big on residential at the moment. We just think there's just a little bit too much risk there. In terms of the office space, high quality stuff like Dexus is trading at anywhere from 5 to 10% discount to NTA at the moment, and they've got a higher yield as well, and they've got high quality buildings like Chifley. So we would prefer something else in that space. So there's just better options essentially. Look, you probably maybe consider it if it gets a little bit cheaper, but I don't. As I said, there's nothing wrong with the business. The consensus from analysts is that it's a buy with potential 20% upside in it overall. But I just think there's better places to have your money at the moment, and if it dips any further and the stats look a little bit better, then potentially it could be an option. But we're pretty bearish on construction as well, just with the rising. I know they do a little bit of construction as part of this. So yeah, we're with the rising input costs and things on those developments. There's potential risk for projects to blow out, etc. So.
Got it. All right, that's a hold at best coming from Mark Gardner from Maqro Capital. Let's get to number 5 on the list, which is Sonic Healthcare. The ticker code is SHL. This is for Verity. Good afternoon to you. Hope you're watching or listening, because we'll get Junbei Liu to start the conversation on Sonic Healthcare. Look, there has been very strong demand for PCR testing. I don't need to tell you why, Junbei. I'd love to go an hour without talking about it. But does that mean that sort of earnings have peaked for the likes of Sonic Healthcare?
Absolutely. So, we have heard from all of its competitors and the like, and the numbers down significantly. If you look at its US competitor, LabCorp, the consensus expectations is that it will be down, 70% this year in terms of testing. There will be still some ongoing testing to take place, but, these businesses make a lot of money out of testing, and then that business is really cut out. Now, for the core business, I think we'll do better because the competitors have shown sort of organic growth coming back, sort of mid to high single digit type of volume growth, which is good. And Sonic is a high quality company. And, eventually when market move past the current extraordinary amount of earnings, it is still a long-term structural growth leader. Now, for the time being, we have seen all the stocks when they struggle, when the earning has to fall for the next 12 months, it's very difficult for market to really get excited or to jump back in and buy them. So, I think this stock, you can buy it cheaper. And then it's something that, in 12 months, the earning will definitely look a lot better as they start to grow from a lower base.
Because they do have a very strong balance sheet, correct me if I'm wrong. So will we start to talk about acquisitions in relation to Sonic as well?
Yeah, look, Sonic is a very acquisitive business, and so it's very likely they will go and spend and buy things. The problem is the market, they haven't really demonstrated a really strong track record in terms of generating return out of those acquisitions over the last 20 years, pretty much, because it's a slow process in terms of how you get synergy and all of that. So, look, I'm not sure if market will give them benefit of doubt straight away, but it will be, accretive on paper. So out of the whole testing space, I think primary, the Helios is the one that you probably looks more interesting because it is smaller, it's cheaper, more domestically focused. It's got a lot of self-help. There's cost out program, so that it will give you a little bit more growth under the same environment, when testing's less. So I think if you want to buy one, primary is Helios is the one to buy.
Got it. Thank you. That's a bonus buy from Junbei Liu. And Mark, can you disagree with something that she said, or are you thinking the same sort of thing?
Strangely enough, Helios is one of our favourites at Maqro as well.
Okay.
So, and they're going to really benefit from, we're talking more about the bonus buy than the stock from the viewer.
That's
but
okay.
But look, they do have a lot of day surgeries, etc., which are actually going to probably fill the gap from the drop in testing, which has given them a nice spike in revenue over this period. So, yeah, we like Helios as well. So we've held that for quite a while now. But with a lack of reporting, that sort of tends to stay fairly stable generally, that stock. But and as well with Sonic, I think they've been a bit of a Clydesdale in terms of they've plodded along. They're super reliable, great balance sheet. Super, I don't want to say boring business, but no, they've just, they've chipped away really well for a long time. Obviously, they've got this spike from the PCR testing, etc. The rest of their business isn't going to make up the difference, say, like a Helios will, in my opinion. So look, I think they've made a recent acquisition in the US as well, and they, as Junbei said, they don't have the best of track records. So it's certainly not like a CSL, which has got a great track record. So look, it'd be at best a hold from me. It's below the 200-day moving average now as well overall, which when it dips below there, generally it'll sort of, it rarely does dip below there. But if they're going to have negative or dropping earnings over the next year, I don't think there's a reason to be in the stock. So. At the moment, I'd be either a sell or a hold essentially, and because I think you'll get either better opportunities or the stock cheaper.
Okay, great, thank you. Let's get to. Oh, excuse me. Thank you. A little bit of a sum up, starting with the stock of the day. So, Baby Bunting is a buy from both of my guests, saying that it reported quite strong. It's perhaps being beaten up a bit because of the broader overall sentiment in Mark's view on markets, but both agree that it's a high quality retailer that seems to be making the right moves and does have growth in its forecast as it opens up those New Zealand stores and expands its footprint in the physical world as well as online. Now, getting to the companies that have been nominated to use, CBA is a buy for Junbei Liu. She says in the operating environment that's only expected to get better, CBA will continue to perform, and she referenced the strong results this week. It's a hold, though, for Mark because he's not overly enthused by the big four banks in general. He would much rather prefer to be in Macquarie Bank. GNG Engineering for Junbei is a buy. She says this company is executing quite well. It's got a strong pipeline, and they have seemed to have avoided some of those severe labor shortages that some of the other mining services, if we want to call them that, firms have flagged. This isn't one that Mark would be buying. If anything, he would prefer to be in Worley. It's got a bit more exposure to the renewables space, more clean and green, and he'd be trimming, in fact, a holder trim for him. Seven West Media, congrats, David. You've done so well on this company so far, buying it at just over 7 cents. But Junbei says, just hold your horses. So does Mark, because this could have some more life in it. Not only does it report next week, where it will likely talk about a pretty solid outlook if you think that the election is coming. So just more that you can squeeze out of this potentially in this cycle. So it is a hold. And even for Mark, saying it's potentially a buy in the lead up to the report, which will be positive. They've played that strategy with 9 before results in the past, and it's worked out quite well for them. Mirvac, very high quality business in Junbei's books, but think about the cycle, think about where we are in terms of interest rates and the housing market and bond yields. It's a hold for her, it's a hold for Mark, but he again would really prefer to be in industrial property names. Sonic Healthcare, Helios is really the one that both my guests, Verity, think that you should be buying if that's what you're considering, because perhaps the earnings have peaked, things will get tougher out there. Potentially in Junbei's view, if you're looking to buy it, you could get it cheaper. And again, Mark just thinks that Helios is the one. And also pointing out that technically it's looking weak right now. As you know, we've got our own portfolio. We've been tracking it since July 1st of last year. Weekly, we are up 2.2% on the month. We are down, though, by 3 3/4. So we're actually underperforming the ASX index, I'll note. And year to date, we're up by 5.36%. But of course, we've been tracking it since July 1st, 2020, and we're up by close to 42% on this day. Now, just that update on the portfolio, just like to keep you well informed. On March 1st, we are launching a new portfolio. We're kicking it up a notch. It's going to be a high conviction fund, much smaller basket of stocks. We'll be taking requests and covering 11 stocks every day as per normal, and still asking our guests for a buy, hold, or sell. So that will be sort of the first filter. So if the stocks get a buy or a sell, just like they do now, they will be going to an investment committee. So the investment committee will meet monthly. They'll decide whether to add or remove stocks from the fund, including weightings. And the whole point of this is to, I guess, give you a look at the sausage factory. So how do real investors think about portfolio construction? What choices do you have to make between companies when perhaps you've already got one of similar ilk in there, even if it's a good one that's been recommended? So we'll have an extra program about that, and I really hope you enjoy it. I'm really looking forward to it. So keep getting those requests in, and we'll keep those going to the filter and eventually the investment committee. All right, next half hour, Aeris Resources, Flight Centre, Aeris, AACO, and Temple and Webster. We'll start with AIS, Aeris Resources. This is for Jake and Archer. I'm intrigued. I wonder if it's father and son or what the story is there, but can we get your view on Aeris Resources, Mark?
I've just, per chance, was looking around for copper producers. We're quite bullish copper for the foreseeable future, just with the infrastructure spending that's been going on by governments, obviously electric vehicle thematic as well. So this one has sort of popped up. It's, you know, smaller market cap, about 300 mil. Look, they've got fairly sensible management. They've got an existing mine that's providing some cash flow. It's not a great mine, but it's kind of funding the exploration. So they're not coming hat in hand to shareholders all the time. I like that just in terms of business ethics. You know, they're paying for themselves, I suppose. At the moment, obviously, being a smaller cap, you would have to just be careful how much you're allocating to it, because the smaller caps do tend to, volatile markets tend to whip around quite a bit. So this thing's only around about the 14 cent mark, or 14.5 cents. So can move around a bit. So you've got to be really careful with your entry price on this. I mean, I like it. I wouldn't be throwing the kitchen sink at it. I much prefer, we've been buying Oz Minerals for the last sort of week or so, which has popped out. Copper prices also popped out pretty well.
Yeah.
So that, pretty nicely. So we're always buying Oz Minerals on the dip, over the last year, and we've done very well out of that. So for your investment grade sort of stuff, I'd be erring towards Oz Minerals. Sandfire would probably be just erring on the side of caution with that massive acquisition. But the copper thematic, with the structural shortage of copper, there's not enough mines at full production to meet the demand for at least the next 12 months. So, but look, I think that could, I'd say speculative buy. I'd be happy to buy it, and probably around here with this 14.5 cent levels, not too bad. But just be careful in terms of your allocation sizing, because it's you can't treat a big cap like Oz Minerals the same way as you treat a small cap like this. But I like the business, and I like the way they operate. So.
Junbei, what do you think? I mean, the commodity story is well known, but to Mark's point, copper has been doing very, very well, and supply is not meeting demand, especially in the years to come, it would appear, at least. Would you stick with the big boys, or are you happy to dip your toe with some of the smaller players in the space?
Look, the big boys for sure, especially the big boys. Oz Mineral has had a big pullback after its slight disappointment to the production report. So it is, Oz Mineral used to be the most expensive copper company maybe a month ago around the world, but it is one of the highest quality management team and highest quality mine site and things. So, so it has come back quite a bit, and, relatively it looked a lot cheaper than what it was. It's trading on forward earning about that 13, 14 times. Still more expensive than many of them, but this is the world class, sort of assets and management. So I would be buying that. Now, having said that, that little one, it's even cheaper because it's smaller. It's a little bit more speculative. In an environment where copper will do pretty well, I do feel that it's something that you can buy as a speculative front, if we put it that way, but much a smaller position in the portfolio, because speculative business is not something you can just put in your bottom drawer and know you'll be okay, whereas Oz Mineral you can, but the other one's got to follow it much closer in terms of what's happening, exploration and all of that.
Got it. Okay, so that's a specky buy. I'm happy with that. And that will go in the portfolio, and we'll deal with it later, how we weight it or whether we stick with Oz Minerals ahead of it. I'm so looking forward to this investment committee.
Lucky there's an investment committee coming up. So.
All right, Flight Centre's next on the list for Shimi FLT. We had that big announcement for the government this week. International flights happening, and inbound tourists are allowed in from the 21st. Have you missed the boat with Flight Centre, though, because we have seen the share price spike, Junbei?
Look, I don't think you've missed the boat. Look, share price spike on the basis of things are going to look great, but when the result comes, all these three companies, so Webjet, Fly Center, corporate travel, I think is okay, but the other two definitely come downgrade. So because the expectations of earnings recovery is too soon, and there's been a lot of disruptions caused by Omicron around the world and so, on that basis, their earnings are all going to be downgraded at this result reporting season. But look forwards, I will absolutely look for opportunity to buy the Fly Center. I will put it on a sort of, longer term buy at this point, knowing short term the earnings might get downgraded and, share price may fall. Usually when earning goes down, share price will go down as well. So share price might fall. And then we may have still yet to have a lot of hiccup in terms of new variants and all of that. In fact, I think I had a dream about new variants coming out. But look, we have...
That's called a nightmare, Junbei. That's called a nightmare.
And so a lot of the things go wrong. But if you take a 2-year view, we will be going through the biggest travel group. So if you want to buy travel companies, Qantas and, the travel agents. So it's definitely high on the agenda.
Okay, so that's a buy, but it is for long term, knowing that you could see the share price go down in the short term. Mark?
I'm a seller, to be honest. Possibly, time frame being the difference in my opinion to Junbei's. And as well, we probably prefer Webjet over that. WebBeds business was the fastest growing B2B business in the world and the second biggest pre-COVID. I think Flight Centre's got a fair bit more debt than Webjet as well. I don't want to be. I don't want to be in the space at the moment. I think you take your money and run with these two businesses with the uplift. I think we'll be a lot slower to return to travel than everyone expects. I think there's possibly better ways to reflect a reopening view that are a little bit safer overall. Look, this would be something that I'd be putting on my watch list and possibly just revisiting in, say, 6 months' time when there's a little bit more stability. It's really not.
Okay.
It's really not a space I think and particularly with VIX above 20 as well. I'm probably looking for a little bit more margin of safety overall. Say last year when the market was on a tear and just rallying fairly blindly, like you had at least had the tailwind of the market behind you if you were coming in and taking the risk on these stocks. I don't think you've got that just at the moment, and there's a lot of really high quality businesses out there that are paying great dividend yields that are relatively
so it's
cheap.
Almost opportunity cost.
It's just opportunity cost. Look, I'd like to see the smoke clear a little bit and a little bit more surety around outlooks. But and obviously Flight Centre was had branches and things as well. So we think probably Webb's is slightly better digital business. So it's just too much uncertainty for me.
Okay.
I'd be avoiding the space for now, and because I think you'll probably get it cheaper at some stage when there's a scare.
Okay, all right. So there you go. Aeris is the next on the list. This one is for Tony. Mark, I'll start with you on Aeris. It reports next week, of course. What do you think of the business?
Look, as a user of Aeris, I'm not a massive fan. Over the years, I've been a professional trader for many years. It's on the lower end of quality systems that I've ever used across the board. I guess that probably sullies my view a little bit in terms of the company. It's very surprising they had obviously that takeover talks at some stage, and they didn't sort of take that on in lieu of there was no other competition. They're going to have to look, as far as traders go who use Aeris. You always see them complaining about Aeris on Twitter. It's a really reliable system. It fits in quite well with the chess system. The rest of the sort of the systems with the bells and whistles.
Sorry, I just got to move it on a little bit.
Yeah.
So you're not a buyer of Aeris, but what about the charts? I mean, so that's personal opinion. What about the charts?
The charts overall, look, it's sort of in no man's land. It's below the 200-day moving average. I'm neither here nor there. I'd probably be a seller really overall.
Sell. Okay, sorry, Junbei. What do you think of Aeris? IRE, the ticker code. What would you be looking for in the report next week?
I don't think the report will be great. I think Aeris is a sell. It's a company. It's a very expensive company that doesn't really grow much. Management has really struggled for growth, and they have put out ever since the takeover potential interested party walked away, which we don't know why they walked away. They had a look at the books and walked away, and then the management put out those really ambitious growth targets, which they never demonstrated their ability. Of the growth target. It's just a very expensive company.
Okay.
I'll holding it.
There, it's a sell for Aeris from both of my guests. Let's get to AACO from Damien. I mean, Junbei, we heard from GrainCorp last week talking about how positive things are looking right now. I chatted with Rabobank last week. Look, these companies really are able to make hay while the sun shines right now. Cyclical, yes, but is now the part of the cycle that you want to be getting into some of these companies, Junbei?
Well, the cycle has gone very, very well for all of them. You know, if you look at GrainCorp, like you said. But look, AACO, I was just thinking, this is probably one of the longest listed company. And they have gone through so many challenges, and this business, they really just struggle to really make much on any investment, this business. Look, it always looks very expensive. I much rather, if you want to play the cycle, much rather to play in a GrainCorp or play in Elders, which is much easier to understand, and they generate return when things are good. Whereas this one, that probably will be staying away.
Okay, so that is an avoid from Junbei. This is for Damien, I should say. Hi, Damien. Mark's going to give you his view on AACO now.
I grew up on a cattle farm, so I've got
you?
a little bit of insight here. They own about 1% of Australia's land mass. So with rural property prices being through the roof recently, the Queensland Northern Territory, they're nearly 200 years old. 1824, I think they were established. They're selling direct to the restaurants and direct into markets, so they're obviously making a slightly better margin than, say, going to cattle sales, which coincidentally Elders runs. I do like Elders as well. I think it's quite cheap at the moment. They pretty much take a clip of just about every fertiliser, cattle sale yards, real estate. I think that's that would probably be my favoured one. But they've got 340,000 head of cattle, and I'm talking to my father who still owns a farm. Yearlings were $1,000 at sales.
Beef prices have been going well.
Yeah, they're now at $2,100 in the last year. So that's a pretty big uplift, and particularly if they've got breeding stock and they came through the drought relatively well, and they're now having to restock. And obviously, being a massive landholder, there's potential upside, but yeah, as Junbei said, they just don't seem to pull a result out. The track record of actually capitalising on it's not necessarily great, but I mean, there's a lot of agricultural companies like that. But yeah, I really like Elders. I don't mind this one just on the. I think there's the ABARE outlook is for another 18 months at least of favourable conditions, so it should have a tailwind behind it. So we probably buy this with a tight stop.
Buy, tight, stop. Got it. And I think there was a bit of emotion tugging at the heart there as well, Mark. Okay, let's go to stock number, we're already at number 10. Temple and Webster on the list. Now, Temple and Webster, of course, did report its results this week. It did get a big uplift on the day, if I'm recalling correctly. Hey, Junbei, I had an interesting conversation with Evan Lucas from InvestSmart because there's been a lot of attention paid to the fact that Temple & Webster has had to spend pretty big on sales and marketing to get this traffic coming through, to get those sales. But Evan Lucas was pointing out that in his opinion, it's very much in startup mode. It's very much a company that is still going gangbusters for that growth and is willing to pay up for it, which I think his thesis was there's nothing wrong with that considering the nature of its business. What do you think?
Oh, look, they need to spend. It's very, very important. It's actually a company that has, in the last couple of years, has been this big beneficiary of, pull forwarding online furniture spend or, homeware type of spending. And it has really established itself to be, the most go-to sort of homeware business online here in Australia. So it's incredible market position, and to stay at that position online, you have to spend, and that's something we all know, and especially at this point when e-commerce transaction potentially will be a little bit lower because people are going out and other things or travel. So potentially volume will be lower in the next 12 months, and all the e-commerce businesses will start spending more. And we heard, all the marketing costs going higher. So it is a common thing across all the industry, and they need to continue to do so. And that is one big uncertainty, I guess, in terms of margin. Company result actually was fantastic. Revenue was strong, still holding up pretty well. They're doing double-digit, sort of over 20% growth, on last year. And then the margin actually holding up better than expected. So I think this, out of the whole bunch, this is one I would buy compared to, other e-commerce businesses. So if you take a longer-term view, you will buy it. However, I think for the near term, earnings it's going to be challenging because they're cycling such strong numbers and because they're expensive relative to the other companies. It's a neutral for me at this point, but I would buy it if I take a one-year view.
Okay, so buy on a longer term view. We always reference cycling those pandemic comps for these e-commerce retailers. This is for Callum. What do you think, Mark, Temple & Webster?
Yeah, I'm of the same opinion as Jumbo. I'm a bit more of a wait and see. They were great results. Their active customers were up 35%, but and their revenues were up per customer as well. So obviously they've got supply chain disruptions. Look, they're essentially, at this stage where the broader market, I think something like Nick Scali or JB Hi-Fi, that's really solid performers. It would be probably, if I was going into this space.
But JB Hi-Fi is quite different than Temple & Webster.
Yeah, look, they are different. I guess I suppose in
just
terms
retailers
of
in general.
Retailers in general, more so hunting for a little bit more yield and a little bit more margin of safety. But yeah, look, this is something that, I definitely have on the watch list, because I think everyone expected them just to fall away after COVID, and I think those results really prove that their strategy's potentially working quite well. So they are expensive, and yeah, look, it'd be just something that I'd like to see potentially just a little bit cheaper, but whether you get it or not, or on showing some momentum back to the upside. I think they've done quite well.
So that is the view on Temple & Webster, and that pretty much, I'm surprised, brings us, gosh, you would be proud, I'm on time, brings us to the end of the program. Before I say goodbye, I'm going to do a little bit of a wrap up of what we've learned, because I'm hoping I can have a minute to just maybe talk about reports coming next week. Aeris Resources, it is a specky buy from both of my guests. They like copper, they love Oz Minerals, I'll put it that way. Flight Centre, it is a buy from Junbei, a long-term buy. There's still water to go under the bridge in the travel space, and that's probably why Mark is not too keen on Flight Centre. It's a time frame thing, and it doesn't have the broader thematic, market momentum behind it either. Aeris, it's a sell for both of my guests. Junbei says it is an expensive company that doesn't seem to grow much. AACO, I think Mark likes this one, cattle farmer, but he also points out that it owns 1% of Australia's land mass. I didn't know that. That's going to be my fun fact this weekend. Roll it out at all the parties I go to, but it is a buy for Mark. He likes elders, so does Junbei, really likes elders. Junbei thinks that AACO just hasn't executed very well. It's been on struggle street a number of times. Temple & Webster, Junbei's neutral on it right now, but she really likes the company. She says the report was fantastic. She would buy it, but with a longer term view. In fact, she says that this company is potentially the best that we've talked about on the program today. And Mark, it's just a timing thing for him. He thinks you'll be able to get it cheaper. He's more of a wait and see, wants to see it either cheaper or when the momentum turns and the cycle or the charts, really, the price starts to really reinforce what appeared to be in that report, which was pretty solid in his view as well. So those are the stocks. Quick thought, Mark, I heard you out in the newsroom talking about BHP. It is one of the big headliners from reporting season next week. You expecting it to be strong? I mean, why wouldn't it be? Iron ore's at 150.
Yeah, but
did come down though in that half.
But we're fairly close to prices we're at when iron ore was at $200.
Yeah.
So. I probably think we had Mineral Resources this week. They're a higher cost producer, but they came off 10%. They've got a few headwinds going there. There's obviously labour shortage issues. Something like Fortescue, I'm definitely trimming at the moment. I don't think they've had lower 6-month average prices. for the commodities. I think BHP's got the unification one-off costs and things as well. We're at really elevated prices here at the moment, so I don't think it's worth the risk carrying your full position through the reporting. I think you'll get an opportunity, if they do report well, to buy back roughly around here anyway. But I really think that where the price is at the moment, there's maybe 5% more upside and maybe a hell of a lot more downside. So both always staples, particularly in this point of the cycle. And obviously China rattling their spears about iron ore prices again as well. I think it took about a month and a half for that to play out before it turned last time. So they've only just started with that, but yeah, like I said, I think there's too much risk here at the moment. Well, I've been trimming out the last couple of days with a view to put it back on. Okay, so BHP reports next week. Fortescue does on the 16th as well. Jimbei, we've got JB Hi-Fi, we have CSL, we have a number of the companies that we discussed today. Aeris, Seven West Media, Seek reports next week. The list, Corporate Travel Management. I could go on. What are you really sort of still looking forward to hearing more from, a company or a theme through this reporting season?
Look, I think the theme has been set. We will hear the stay-at-home guys like the JB Hi-Fi and things. The things conditions good, but then look forward to things challenging. So it shouldn't be any surprises out of JB. But there is one, I think the result is going to be very strong and very positive outlook, which is share price actually come off as a result of growth companies sold off. But if any company will have upgrade, this one is well in the camp of a very strong upgrade. Forward to that. CSL has been sold off. I think because essentially it's because they the IG volume is still very, very weak from the competitors' thing. But I think there's a lot of negativity in the share price. I think when the result comes out, maybe okay. I think overall theme reporting season, we're not having a bad reporting season. It's pretty good. It's just the macro overview sort of throwing it around. But look, put that aside, fundamentally very strong for companies. Earnings still growing and outlook still looks good. Supply chain disruption for some issues for the margin, but over the next 6 months we should see that better. So, so it'll be pretty good reporting season.
Great. Jimbei Liu from Tribeca Investment Partners. It's so good to have a chance to speak again. I hope you have a good weekend. Thank you for joining us today.
Thank you so much, you too.
Thank you. And Mark Gardner joining us from Maqro Capital. Likewise, I'm sure those four girls plus will keep you very busy this weekend. Have a good one.
Indeed, yeah.
All right. If you have any companies that you'd like us to cover, feel free. The call at ausbiz.com.au is the email, or you can tweet us at ausbiztv. And a reminder that you can look at that portfolio we talk about a lot at ausbiz.com/portfolio. Coming up next on the small caps, I'm chatting with Richard Ivers from Prime Value.